There are tons of ways for prospective buyers to finance their new home in today's market. We want to make sure you're the expert for your client when it comes to their options. So today we're going to cover assumable mortgages. You want to stay tuned, we're going to cover it right now. The first thing you're probably thinking is, what is an assumable mortgage? Nobody knows. That's why we're covering it, and try saying it 5 times fast. Assumable mortgage, assumable mortgage, assumable mortgage. It's very difficult to say. So what is it? It provides the buyer with an opportunity to take over the seller's mortgage loan, right? So a client wants to move into their house. They're not just taking the house over, they're also taking their loan over. One reason buyers may decide to take over a seller's mortgage is to take advantage of the financing of a lower interest rate. How do you know if your client qualifies for an assumable mortgage? Because it isn't for everybody. Typically, loans that are insured by the Federal Housing Administration, or FHA, or backed by the Department of Veterans Affairs, which is VA, or United States Department of Agriculture, which is typically buying farmland, are assumable as long as specific requirements are satisfied. For most FHA and VA loans, a seller must obtain a lender approval for an assumable mortgage. In most cases, conventional mortgages are not assumable. So make sure if they are doing an FHA or a VA, especially when you're dealing with houses, have them check with their lender to see if they qualify, if they meet those needs. There's a few different rules and you want to make sure you don't misspeak, but now you know a little bit about what qualifies. How does an assumable mortgage actually work? An assumable mortgage works much the same as a traditional home loan, except the buyer is limited to the financing through the seller's lender. The lenders must approve an assumable mortgage. If entered incorrectly, the sellers run the risk of having to pay the full remaining balance up front. So you don't want to make that mistake. Sellers also risk that buyers missing payments, which could negatively impact their credit score. That's important, so make sure you really understand that one. One major advantage is that you don't need an appraisal. It's not required for these instances for this particular situation, which can potentially save buyers hundreds of dollars, which does add up. Buyers should still order a home inspection to check for any signs of repairs, of course, but they won't need a traditional one like they normally do on a home loan. Once the buyer closes on the home, the seller no longer is liable for the mortgage payments, which is fantastic. So make sure you really understand what you're getting into and the ramifications, and make sure the lender and the client buying the house and the seller, all three, are on the exact same page. Pros and cons of assumable mortgage. I've said it probably 12 times, I don't know if you're counting, so I challenge you to do the same when you're talking to a client. Try to say assumable mortgage 12 times. When determining the pros and cons of taking over a mortgage, consider any additional costs, paperwork, and time frame needed to process the loan. While it might make sense to avoid higher interest rates through the seller's lender, it still might benefit them to shop around before committing to anything officially. Specialty mortgages sometimes require additional time for approval by government agencies or require higher down payments depending on the type of loan. Also, make sure that everyone's on the same page. Assumable mortgages sometimes will push back the loan closing date. So if somebody's in a hurry on the buyer or the seller's side, assumable mortgage may not be a great idea. Bottom line, mortgage assumptions can be a valuable option for those looking for the possibility of a lower interest rate, especially in today's market, and a simpler home buying process, which is awesome as well. If you're willing to take the risk and put the trust in the home seller and the lender, there's a chance that home ownership could be a lot less of a headache, a lot less of a stress, and a lower interest rate for your clients. Like I said, I wanted to give you a few details on mortgage assumptions. Make sure you check with a loan officer. You're not an expert, but just enough information where you look intelligent in front of the client. I'm Colby Sway with Inspiring Agent. We love seeing your comments. If there's anything you want us to make in the future, let us know. Subscribe, like, and you know you're going to see us again in a few days.